Hi everyone, Jamie the Broker here. What we're going to do today is we're going to do a jargon buster. I've had messages, DMs, feedback, WhatsApps. Everybody just would like me to simplify how a mortgage works, the common terms you're going to hear in a mortgage. By the end of this, you guys are going to know what you're talking about, trust me. So the first thing we're going to talk about is loan to value. So this term, often referred to as LTV, you're going to hear throughout the process. And the reason you're going to hear loan to value, because A, this will determine how much deposit you're going to put down, and it also determines your interest rate. Nice and simple. Value of your property to the loan that you're going to get from the bank. If a property is 200,000 and you're putting down a 10% deposit, which is 20,000, your loan is 180,000. So your loan to value is 90%. The reason loan to value is important because it determines your interest rate. If you put down a 10% deposit, your interest rate is going to be different to if you put down 15% deposit or 20%. So the bigger deposit, the lower interest rate you'll pay. My favorite one for this jargon buster is a decision in principle, often referred to as an agreement in principle, a mortgage promise, an AIP, a DIP, a DIP. It's all the same thing. It's an estimate of what a lender is willing to lend you before you finalize your property purchase. It's not a full mortgage offer, it's just an estimate. So once you're ready and you're in a position to proceed with a decision in principle, the lender will run a credit search on yourselves. They do two things. One option is a soft footprint search. Second option is a hard footprint search. Majority of lenders in the market at the moment will proceed with a soft footprint. And this is because a soft footprint doesn't affect your credit in any way, regardless of the result. Whereas a hard footprint can actually affect your credit. Once a decision in principle is done, there are three results you can get. Number one is an accept, and that's what you want. You want to be accepted by the lender. My clients always get an accept. Option two is a refer. A refer just means that the lender wants to look at the case in more detail and they will come back to you with either an accept or a decline. Lastly is a decline, and that's where the lender can't proceed with the application at this point in time. Decision in principles, majority of the time, last about 3 months. Once they are expired, you will have to do one again, but depending on the lender, 3 months is normally the standard. Decision in principles, for me, really important. And the reason why is because it shows your intention and it shows that you're serious, that you want to buy a property. A majority of estate agents at the moment won't even allow you to go on a viewing without a decision in principle, particularly in a pandemic. Valuations happen commonly if you're remortgaging, if you're purchasing a property. Majority of the time, a valuation will need to take place. A valuation is where a lender sends a professional surveyor out to value a property. So if you tell me you've had an offer accepted at 500,000, the surveyor needs to go around and make sure that that property is worth 500,000. You need to think yourself, if you was to lend someone hundreds of £1,000s, you want to know what you're lending your money on, and that's exactly what a survey is. Surveys now, a majority of them, especially if you're doing a remortgage, the majority of surveys you don't have to pay for, however sometimes you do, and if you're just purchasing a property, majority of them you don't have to pay for, but there are a few lenders in the market that will charge you normally up to about £200 for a survey. There are other surveys that can be done, such as a building survey, home buyer survey. Like previous posts, I will tell you a little bit more about those type of surveys. Obviously guys, as we are in a pandemic and under COVID rules, some lenders are doing something called a desktop survey. What that means is they don't actually have to physically send a surveyor around to visit the property. What they actually do is they use technology. They look at what prices have sold for in a quarter-mile radius in the local area, and that's how they determine how much the property is worth. Not all the time will someone actually go out and visit the property. We're in 2021 now, and they can actually value a property from a laptop pretty much. Everyone, I hope that was useful. I'm sure it was helpful. Please like, follow, subscribe, share, all of that stuff. Always wanted to say that. There'll be more Jargon Busters coming soon, so stay tuned.